Getting a mortgage is a big decision and one of the biggest financial instruments you will ever take on. There are lots of different types of mortgage, but today we're just going to look at one element. Should you go interest only or capital repayment? First, let's examine each in turn. In this example, we are buying a house for £100,000, a nice round number that will help with our calculations. For a standard mortgage, you'll normally need to put down a 10% deposit, in this case £10,000. We will cover buy-to-let a bit later. This means we need to borrow £90,000 as a mortgage. This gives us a loan-to-value of 90%. So we have our house, we have our mortgage, and the difference between the two, 10% here, is called our equity. Right. Now let's see what happens over time. It's generally accepted that house prices will rise over the long term. So here you can see the value of our property is increasing over 25 years. Now let's look at a repayment mortgage. We've borrowed £90,000 from the bank and we have to pay interest on this every month. Let's assume an interest rate, or APR, of 3%. This works out at £225 per month. We are also paying back some of the £90,000 each month, so that we've paid it all off at the end of 25 years. We won't cover this calculation here, but there are plenty of websites that do it for you. Suffice to say, the repayment amount is another £205, which brings our total to £430 per month. So every month we pay £430 and the value of our mortgage decreases. This makes our graph look like this. As you can see, our equity increases significantly over time. At the end of 25 years, our home has gone up in value and we no longer have a loan. This sounds great, but there are some things to think about. Interest rates could go up and increase your monthly payment. You might move to a bigger house and increase the size of your mortgage. You might remortgage to free up some cash and thus also increase the size of your mortgage. At the end of 25 years, the equity in your home is only useful if you take out a new mortgage, thus taking on more debt, or sell your house. This is why I don't really consider your home to be an asset. Yes, it's worth something, but the money's locked up and you can't really get at it. There's a great culture, especially in the UK, of being a homeowner. This is tied to the crazy myth of working for 40 years to enjoy retirement on your pension. People strive to own their own home because it is perceived as a great thing to do. And yes, once you've paid off that mortgage, you can live there for free, but economically it's not necessarily the soundest strategy. Okay, so let's see what an interest-only mortgage might look like. In this scenario, the interest we have to pay, £225 per month, is the same. However, we are no longer paying the extra £205 per month to repay the mortgage. Over 25 years, it looks like this. At first glance, we appear to be in a sticky situation because our equity is not as good and we still have a big loan to pay back. This is the scenario people often fear when choosing what mortgage to go with. But consider this. Your monthly payments are almost half as much. This is a great way to get on the property ladder if you can't afford a repayment mortgage. It also means you have an extra £205 per month to invest every single month. Even if you put this in a savings account at 5% interest, over 25 years this would amount to £122,000, which is enough to pay back the mortgage with £32,000 to spare. Or you could invest in other assets which would help to further increase your income. Alternatively, you could just take out another mortgage to extend the term. Your loan to value will be much better due to the increased equity, and you still have plenty of equity in your home to cover repaying the mortgage in the worst case scenario. So, which should you choose? Well, it depends on your strategy. Both options have their pros and cons. If you want to be a traditional homeowner or you don't care about investing, then get a repayment mortgage. But if you want more cash and want to build a passive income stream, it may be better to go with interest only. However, if you are going to find it hard to be disciplined with investing, you could always get a repayment loan and then remortgage it in a few years to release some capital. Now with buy-to-let mortgages, it's generally preferable to go with interest only. We'll cover this a bit more in the future. If you have any questions, please leave them in the comment section below and let us know your preferred strategy. If you found this video useful, please like and subscribe so more people have a chance to view it.